Okay, so these 10-year yields have been soaring. All these treasury yields have been soaring, which is correlated to loans increasing in the rate in general. So I want to kick it over to Starwood Capital Barry, who's a lot more in tune with what's going on in the world of economics and finance. So I'm going to play some clips of his so we can listen to it, and then we can talk about it a little bit and break it down for everyone watching. Check him out.
Our economy was going to slow on its own. The $6 trillion of stimulus packages that were given to American consumers, they've spent it.
President Biden.
And you can see their credit card balances going through the ceiling. So we were going to slow. On top of that, he decided to really rapidly increase interest rates.
Talking about the Federal Reserve Chairman.
Stay low forever. He's doing this at a pace we've never seen before. We've never seen rates go up this fast. We could absorb slower increases this quickly after telling us that rates would be lower longer in December of 21. And then, of course, he's kept actually easing through May of 22. He was buying corporate bonds. So he pulled a very fast turn. He missed inflation when it was really there because of the lags in the federal data. Our apartment rents went up 20%. We own almost 130,000 apartments in the United States. And he didn't have that in his data. And when rents started to fall, he's now showing the rent increases that were now over a year old. So I don't agree with Larry Fink, and he knows that. I actually think rates will come down in the United States because they'll have to come down. You cannot, people who talk about Paul Volcker and say that,
this is key right here too.
During Trump Powell of Volcker, that 22% interest rates slowed inflation. Volcker didn't have a $33 trillion deficit. He had a $200 billion deficit. It didn't matter what rates were. But today, the biggest victim of the Fed increasing rates is actually the federal government that now has to pay 5% on $33 trillion of debt, not all of which rolls today. And then the second victim are our banks, the regional banks, which have...
So I want to just show you how the credit card balances have been growing. It's kind of what he was touching on right now. As we can see, during the Great Recession, they skyrocketed, then they went down. And then as we were into 2019, going into 2020, it went back up, and then COVID happened. So, people's credit card balances went down because all the stimulus. So that's kind of what he was touching on, how now it's growing back up. And what happens when it goes up, those credit card balances, usually some issue in the economy essentially happens. And then he was talking about the Federal Reserve Chairman left the Fed funds rate very low at 0% for the longest time. So during 2020, he said there was no inflation issue. And then, they were a bit late on that, and they realized, oh, shoot, there's a lot of inflation going on with all this stimulus, not only from COVID, but then when President Biden came in with an additional $6 trillion, it just went all the way up. And that's why we're seeing issues right now with mortgage rates. 10-year yield is also tied to that too. This little guy right here, this yield, this percentage is tied into the Treasury bonds for the 10-year in terms of the maturity note. And when this ticks up, that's when you see mortgage rates, a lot of it in the jumbo loan tied into it. And I know this is a lot of information, but we're going to break it down in a second. But I just want to kind of set the playing field out, because at one point we hit 5% in the 10-year yield, and that's what caused a lot of chaos. That's why we got the 8% mortgage interest rate and things like that.
I was interested to hear who he said were the biggest victims of this. I think he started saying the federal government.
I'd love for you to talk about that. Yeah. Okay, so there's just one more thing I want everyone to hear, which is right here from Barry.
But on the other hand, we're all trying to lower inflation. And our biggest issue in the United States, and the reason the economy remains strong, is that we have all these stimulus package that the government has put together, the CHIPS Act, the climate bill, which is really, they put out over $100 billion in that. You have the $1 trillion construction bill, infrastructure bill, the cumulative impact of which is actually holding up the U.S. economy while private enterprise is getting a little peaked. So you have a tug of war between the federal government spending and the private sector saying, ouch, these interest rates are hurting. And it's really changing things, and it will create future inflation. Like, we're not building enough homes. Nobody will build enough homes with interest rates this high. So it's really, the Fed is hurting themselves. And I do think we've seen the top of rates in the United States. The only wild card is oil. Obviously there's that's something.
So look, I think a lot of people, so we're watching this guy who's obviously really rich say these, look, interest rates are the most boring thing in the world. If you were to bring this up on a first date, there wouldn't be a second date. That's kind of the problem, is that this stuff is all very boring. And so that's why people stay poor. But I think people that are watching might want to know, hey, look, how does this affect me? So a lot of the viewers here,
Mm-hmm.
they might see a video like that, and there could be a realtor, a buyer, or a seller. How can that information help them? Are we going to see a decrease in the numbers of buyers or sellers? Are there any tips we can provide them? Any kind of buyer or seller in this market? Are there any creative financing options that we can explore? How can we use this information right now to help us in the future?
Yeah. So basically, there's two different opinions going on. The Barry, the Starwood Capital guy, and then Larry Fink, who's in charge, I think, of Blackstone or BlackRock. I think it might be BlackRock. But in any case, they're both finance gurus, right? Billionaires. One thinks rates are going to remain high for a significant amount of time, which is Larry Fink. And then you got Barry saying eventually, very soon, rates are going to have to fall to re-stimulate the economy because of the headwind that it's getting from all these stimulus packages and the debt and the government paying on that debt, right? The interest, because it's at that 5% now rather than the 0% where the Fed funds rate was before. So the reason why that's important to buyers and sellers is the market is going to be rocky for the time being. Like last year, June 2022 till about December, we saw prices slip because of the affordability issue. At the time, rates were not too high at all last year. And then all of a sudden they went up to 7% and prices slipped then. Now we're looking at earlier in the year, we were around, I think 3 or 4%, I think 4%. And then we saw now rates are at 8%. So it was very quick to go on during the year, and that hurt affordability. And buyers are now seeing the headwind of having to spend so much more on that monthly payment. And in order to meet that demand, sometimes the sellers have to, drop the price a little bit. So that's kind of what we're seeing here. And that's why that video was quite important. And I just want to make sure that kind of makes sense from the angle I'm throwing it at you guys.
Well, it sounds to me, and obviously Nick, weigh in. It sounds to me like there's not really a tip or a trick. It's, hey, it's going to be rocky for a little bit. Hold on to your butts.
Good point. I think the tip, though, there's a tip in there for most people is, yeah, hold on, it's going to be an issue. But what about the people that are living in oblivion saying, oh, I'm going to end up buying when the rate drops to 5% or 4%? Because there's a lot of people that think the rates are going to drop to 3% back during the pandemic era. And I think the tip there is it's probably not going to get to that point. They may drop, like Barry says, but to what extent? So it's a matter of now just finding the right moment to be able to buy in the near future, hopefully, rather than being on that wish list and never affording a home or purchasing a home for that matter.
Yeah, and just on that note, right? So, I mean, I agree with you, Andrew. I think they will drop. I don't think they'll drop as far as they were, right? Especially not as rapidly. It's going to take time.
Well, that's what Barry said.
A lot of people, yeah, right. But I think a lot of people also forget, before all of our time here, there was a time where interest rates were like 20% or something, right?
Right.
And what was that back in the 70s, 80s, right?
80s, yeah. 70s into the 80s.
70s and 80s. And people now kind of have forgotten about that, but it's a complete possibility where it can get that high again, And as far as
point, yep.
Yeah. And as far as, possible tips or tricks or things that being a consumer myself, right? And a buyer, I think that if you are able to find a deal in this type of economy and with these type of interest rates, then in either case, it's going to be a deal, right? So if interest rates go up, well, you got the lower interest rate. So as long as you're making cash flow, that's all that really matters, right? Mm-hmm. If rates go down, then you could always refinance and then you're getting more cash flow. So it becomes even of a better deal. So I think it really all depends. If you do find a deal now, take it. There's no reason to wait, because if you're going to wait, maybe they'll go up, maybe they'll go down. Mm-hmm. But in either case, if it's cash flow, and that's the main thing that counts at the end of the day. And I do
if it works, it works.
Yeah, exactly. And as far as creative finance, there's always creative financing options. I mean, if I follow Pace Morby, right, and he's just one of the ones who's big on creative finance, and he's consistent. Him and everybody in his community is consistently talking about and finding deals where they do creative finance, right, and helping other people get out of situations that have put them in a financial predicament. So there's options out there.
Mm-hmm. What do you think of that, Chris? Because I think
Well,
it goes
no, I
to
mean,
different levels too.
I will say that message sounds a lot more positive than the video we watch, which is obviously just a warning. It's identifying the problem.
It's a warning, right?
Well, it's more of a prophecy, right? And I think we've all in 2020, early 2020, I was like, should I buy a property? So worried that we're at the top of this thing, and probably should have bought at that point. Didn't buy at that point because it's so high. The market's doing so good. It's really, you see a lot of people buying at the top of a market and regretting it. But we all know 10 years, 15 years, no matter how high it is right now, you will eventually make your money.
Right.
It's like real estate, especially along the coast area, is a for sure stock that's going to go up at some point,
Right. I think, though, the elephant in the room for what he's portraying here is the problem that keeps getting kicked, like the can keeps getting kicked down the road, which is basically that the U.S. government owes all this debt. So Paul Volcker was a federal chairman back in the 80s when, like Nick was saying, those mortgage rates were very high, and so were the Fed funds rate. But he only had $200 billion in debt for the U.S. government. Now it's at $33 trillion. So that's kind of the pushback he was giving the other guy, Larry Fink, saying, well, he might think that rates are going to keep going up for so long. But Barry's point is eventually those rates have to fall to stimulate the economy, or we're going to be like in a depression scenario because the government has to pay 5% as of right now. The Fed funds is like 5.25% to 5.5%. They're going to have to pay that interest rate back on top of the debt that we currently have right now. Because over the last years, we've been surviving by only paying 0% interest rate or 1% to 2%, and now it's 5%, and it might keep growing. So
that's not to mention that the people in charge of the budget and have been wildly irresponsible with the money compared to how much is being brought in.
Right, and they're wildly getting rich off of this too.
Yeah. But you actually make a really good point, Andrew, because I do want to caveat or add to what I said earlier, right? So based on your point that you just made, where if all this debt to the economy, and say we do end up going into a very deep depression, and home values significantly drop, right, where people go underwater in their mortgages, and I think from an investor standpoint, at least, right, if the property is cash flowing and rents are able to stay where it's cash flowing, then you're okay. But then if you have that property value drop, right, you go underwater and rents also drop, then that's where you're in a predicament. And then for people who are buying houses for themselves, right, if you're able to buy a house, and I mean, so many people are advocates of this, don't necessarily buy liabilities, right? Or don't take on more expenses until you have cash flow to pay for those expenses, right? So I think following that rule of thumb for somebody that wants to buy their own place, right, and live in it and occupy it is still a good rule of thumb, even if we do go into a very deep depression and they go underwater. But it depends on where their cash flow is coming from, and that's another reason to diversify. So
right, and more than likely, though, I'm not trying to say that we're going to hit a depression, but some people might say that, but probably unlikely, I think. And the only reason why I think that's unlikely is because we're still the reserve currency in the world, and the fact is, or the matter is, and we'll do this on another podcast. We can talk about it a little bit, especially Chris might like this topic, which is basically to talk about the military-industrial complex, which does help our GDP. There's this guy named Andrew Bustamante that basically alluded to the fact that the reason why the U.S. economy's GDP is constantly, it doesn't necessarily go down like it technically should. It's continuing to gradually stay where it's at or go up is because of the military.